You're listening to Corner Room, where we break down the stories behind the headlines. I'm Alex, and I'm your energetic guy today, ready to jump headfirst into, well, a really complex and fascinating stack of material we've got.
And I'm Maya, here to synthesize the data and, connect those strategic dots for you. Today's deep dive is, I think, less about what just happened last week and more about the growing pains of these huge sectors.
Growing pains is the perfect way to put it. We're talking crypto, AI, EVs.
Exactly. All of them are moving from that pure hype phase into, well, actual regulated markets.
Okay, so on the agenda today, we are absolutely dissecting the institutional guardrails going up around crypto. We've got new UK stablecoin rules and a huge hint from Michael Saylor about Morgan Stanley.
Then we're going to pivot to an AI reality check, why a company like Anthropic had to sort of pull back the leash on its own code-generating AI.
And we'll finish up with some wild market swings and the pretty chilling global risk from North Korea's cyber theft operations.
It's a massive slate. But the theme running through all of it is maturity. Every single story is about a sector being forced to grow up one way or another.
Let's do it. Let's unpack that shift, starting right where those guardrails are being built. Crypto's institutional and regulatory maturation. First up, the UK.
Right. So the Financial Times is reporting a really significant move by the UK's financial regulator. They're drafting some seriously strict rules for any firm that issues or, trades cryptocurrencies.
And their main focus is on stablecoins, which we should probably define real quick.
We should, because people hear crypto and they just think, wild volatility. Stablecoins are supposed to be the opposite.
The calm in the storm.
Kind of. They're digital tokens designed to hold a fixed value, usually pegged one-to-one with a currency like the US dollar. They're the plumbing, really, the digital cash that lets the rest of the market work.
Right. But when that plumbing breaks, the whole system floods. We've seen that happen.
We have. And this is a direct response to failures like Terra USD. So the new rules would mandate that issuers have to hold fully backing assets, real cash, or things that are just as liquid.
So no more magic internet money propping it up.
No. And they'll have to go through rigorous regular audits. It's basically forcing them to act like a regulated bank.
Which gives people confidence that if they want their dollar back, the dollar's actually there.
Precisely. And it's not just the issuers. The exchanges trading these things will also have to hold more capital, kind of like traditional brokers.
So the UK is basically rolling out the welcome mat for legitimate crypto firms while shutting the door on the Wild West stuff.
That's the strategy. Provide clarity, provide stability, and attract the serious players.
Okay, so that regulatory groundwork leads us perfectly from the regulator's office straight to Wall Street. Michael Saylor.
Yeah, this is where you can really see the structural shift happening. Saylor, the CEO of MicroStrategy, is already famous for having over 200,000 Bitcoin on his company's balance sheet?
A legendary amount.
But a recent hint he dropped, which the Street reported on, suggests he's trying to pivot the entire company's role.
How so? It sounds like they're moving beyond just holding Bitcoin.
That's the key. He suggested MicroStrategy is close to white labeling its Bitcoin management tools for a massive platform like Morgan Stanley.
White labeling. So they'd provide the engine, and Morgan Stanley would put their own brand on the car.
Perfect analogy. Morgan Stanley has the clients trillions of dollars in wealth management, but maybe not the core infrastructure to handle digital assets at that scale.
So MicroStrategy just steps in and provides the compliant, secure backbone for custody and trading.
Exactly. Morgan Stanley can then offer it to all their wealth management clients, fully integrated. It completely slashes the compliance and development headache for them.
Wow. If that happens, it's not just another company adopting Bitcoin. It makes institutional access scalable. It's the compliant on-ramp the big players have been waiting for.
It accelerates things way beyond what the ETFs did, because this goes right to the heart of private wealth management. A huge signal.
Okay. From huge institutional guardrails to the very fine-grained ones needed in AI, let's talk about this vibe coding reality check.
Yeah, that term comes from Boris Cherny at Anthropic, the company behind the Claude AI models. Business Insider did a profile on him.
Vibe coding. It sounds fun, but what does it actually, mean?
It's the AI's uncanny ability to just get the vibe of a huge code base. It picks up the style, the structure, and then it can fill in missing pieces or just generate tons of boilerplate code for you.
Which sounds like a developer's dream. It's all about speed.
It is. But then Anthropic, one of the leaders here, suddenly put stricter limits on how much code Claude could generate.
So why hit the brakes on that speed advantage?
It really comes down to a clash between speed and responsibility, specifically intellectual property and, quality control.
Ah, the liability question.
Totally. When an AI is trained on like the entire internet, that includes a lot of proprietary copyrighted code. If it then spits out a huge chunk of code that mirrors a protected pattern,
Who's on the hook for that? The
Yeah.
developer or Anthropic?
That's the billion-dollar question. So by limiting the output size, Anthropic is managing its risk. They're making sure the AI is just a helper, giving you snippets and guidance.
Not writing the whole novel for you, which might be plagiarizing.
Exactly. It's the realization that you still need a human author in the room to make sure everything is safe, legal, and actually works right. AI is the world's best assistant, but you're still the boss.
Speaking of things moving fast, let's talk about market speed. We have to cover Rivian's absolutely insane one-day surge.
Yeah, the electric truck maker. Their stock jumped nearly 40% in a single day, closed around 29 bucks. That kind of move is, wow, it's wild.
What on earth could cause that? Was there an acquisition?
Not even. It was a surprise unveiling. Rivian showed off a new, more consumer-friendly SUV model.
Okay, so a new product.
But one that directly addressed the biggest investor fears. A lower price point, faster charging, better range. It hit all the right notes.
Hold on, though. This is Rivian. They're kind of known for missing production targets and having supply chain issues. A 40% jump feels like it's purely based on hype, not reality.
And that's the essential skepticism you have to apply here. The price jump reflects the potential of them delivering, not the fact that they've delivered. The announcement is perfect, analysts got bullish, and it just poured gasoline on the fire.
So the long-term story still depends on whether they can actually build the thing.
100%. Can they build it at scale profitably without hitting all those same old traps?
A necessary dose of caution. Now let's contrast that with a pullback in a sector that's supposed to be the future. AI chip makers, Nvidia, Broadcom. They're sliding.
Right. MarketWatch detailed this. We're seeing pullbacks of 5, 10% after these massive rallies. And the question is, if AI is everything, why are the companies building the shovels for the gold rush taking a hit?
So what's driving the sell-off? Is the AI boom already over?
Oh, not at all. Not the tech momentum. It's the stock price momentum hitting reality. There are really three things going on here.
Okay. First, just simple profit taking. Traders who got in early are locking in their gains after the stocks hit all-time highs. Makes sense.
Can't blame them for that. What's number two?
This is the important one. It's concern that revenue growth won't keep up with the sky-high expectations. Building out AI infrastructure is incredibly expensive.
You mean all the data centers and servers? That costs a fortune?
A fortune. And companies have to spend all that money now to buy the chips, and the real payoff from that investment might take longer than the market hoped. That gap is making investors nervous.
And the third factor?
Just broader market jitters.
Yeah.
Worries about interest rates, slowing growth in places like China. So this isn't the death of AI, it's just a recalibration. The hype is meeting the real-world investment timeline.
Okay, let's bring it back to digital finance, but move from stocks to a really deliberate play for mainstream banking by SoFi.
Right. IBD reported that SoFi, which is already a huge online lender, has officially launched its own US dollar stablecoin, SoFi-USD. That feels like a bold move for a company that's trying to compete with traditional banks. What's the strategy?
They want to be the bank of tomorrow. By putting SoFi USD right inside their app, they can offer users 247 payments, a way to earn yield, and this is the critical part, instant transfers between their regular bank accounts and their crypto accounts.
The instant transfers. That's a killer feature.
It is. It completely gets around the slow, clunky transfer delays of old-school banking, and it means you don't have to go to a third-party exchange, which might feel, risky to some people.
So it's an all-in-one shop. It's about efficiency and trust.
Exactly. They're making a big play for anyone who's just fed up with the friction of the traditional system.
Okay, now for a case where compliance and integration are not going so well.
Yeah.
Let's talk about the intersection of politics and finance with the Trump media SPAC deal.
This whole saga has been going on for a while now, covered extensively by Politico. The company has been trying to merge with a SPAC called DWIC since the middle of 2023.
And a SPAC is just a shell company, basically, designed to take a private company public faster than a normal IPO.
Correct. But in this case, the SEC, the regulator, just keeps hitting the pause button. We see these repeated 3-month delays.
What are the specific roadblocks? What's the SEC concerned about?
It's not just one thing. They've raised flags about the company's financial disclosures, its corporate governance, and claims made to investors before the deal was announced. It's really about whether the company is ready for public markets and if its valuation is accurate.
That kind of regulatory uncertainty has to be poison for investor confidence.
It is. The stock has been on a roller coaster. It initially shot up on pure political enthusiasm, but the constant delays and regulatory questions have caused it to drop. It's now trading way below that standard $10 IPO price, which shows you just how skeptical the market has become.
And finally, let's turn to the dark side of digital finance and a really critical geopolitical risk: North Korea's crypto heists.
Yeah, NBC News detailed some recent research suggesting that hacking groups tied to North Korea stole over $2 billion in crypto in 2025 alone. The scale is just staggering.
$2 billion. How are they pulling that off? What are they targeting?
Their main targets are decentralized finance or DeFi protocols, centralized exchanges, and something called bridge services.
Let's do service.
Think of it like a digital toll booth that lets you move coins from one blockchain to another, like from Bitcoin to Ethereum. Because they handle so much value moving between systems, they're often a single huge security weak point.
A prime target.
A prime target. And North Korea hits them with phishing, malware, sometimes even using insiders to just siphon out the funds.
And once they have the crypto, how do they turn it into actual cash for the regime?
It's a very sophisticated laundering operation. They use services called mixers, which are like digital laundromats that tumble coins from thousands of sources together to hide where they came from.
And that laundered money goes where?
It's used to fund the regime's most sensitive operations. We're talking their nuclear and missile programs, their global cyber espionage. It's a direct line from a security flaw in DeFi to, well, a major global threat.
Which means the response has to be just as serious. Better security, better tracking.
It's a huge cat and mouse game. It requires stronger security across the board, better identity checks on exchanges, and high-tech blockchain forensics to follow the money.
Ooh. Okay, we covered a huge spectrum today. From UK regulators trying to stabilize the market to MicroStrategy maybe becoming the plumbing for Wall Street.
And then the reality checks for AI code generation and chip stocks, SoFi's big digital bank play.
And ending with those very real geopolitical risks from hacking.
You know, the common thread through all of this is that shift from just pure innovation to structural integration. Every sector is having to figure out how it fits into the real regulated world.
That's a great takeaway. You can't really think of these as separate fields anymore. If you're feeling a bit overwhelmed by all this, maybe just pick one of those connection points to explore.
Like how a traditional bank like Morgan Stanley even begins to think about adapting to a fully digital asset.
Exactly. Those small, focused steps are how you build real expertise that actually lasts.
I agree. Spotting those strategic shifts is what separates being informed from just reacting to headlines.
All right, friends, that's it for today's deep dive on Corner Room.
Thanks for tuning in. We'll be back next week with more stories to inform and entertain.
Until then, stay curious, stay calm, and keep musing.
Bye.